Evolve or Perish. Chapter 19. Economic Piracy. Under our present system, capital is permitted to earn a reasonable return on investment. When the investment takes the form of a mortgage, the normal return is 5 or 6%. If the investment is in bonds, the return is nearer 3%. There is a general movement at the present time to refinance all commercial obligations calling for 5 to 6% interest and replace them with issues paying 3 or 3 5/10%. When the investment takes the form of short-term loans, the returns drop very low. During the past 2 years, the rates have dropped to a small fraction of 1%. There is another type of investment, represented by shares in the stock of industrial enterprises. There are 2 principal forms of shares, preferred and common. The preferred stock shares have many of the characteristics of bonds. The return is at a fixed rate comparable to that of bonds, and preferential payment out of earnings is made before returns are paid on common stock. Holders of preferred stock have no voice in the affairs of the corporation as long as the fixed return is paid. Holders of common stock, acting through a board of directors, run the affairs of the corporation. Money subscribed by stockholders is used to set up a production establishment, the money being used to purchase land, buildings, and equipment. In this physical establishment, an organization is created for carrying on the activities of production and distribution. The goods produced are to be sold at a price which will cover all costs plus a profit. The profit is the return to the stockholders on their investment and should be at the same rate as that on bonds or equivalent securities. The stockholders are the owners of the real estate, buildings, and equipment purchased with their invested capital. They are entitled to have it protected and maintained. No one has any right to take any of this property away from them, and conversely, they have no right to take any property from other individuals and organizations without just compensation. An accounting at any time should show that the stockholders have made a given investment of money in the corporation, and that the corporation continues to hold title to the properties purchased. It should show that the corporation has received from operations a return of approximately 6%, and that this amount has been disbursed pro rata to the stockholders, minus such nominal amounts as were necessary expenses for administering the investment and disbursing the proceeds. When these requirements have been met, the interests of capital have been satisfied. It is not entitled to any increase beyond this, although a 6% return on capital satisfies every requirement, legal and ethical. Nevertheless, capital obtains many forms of increase in addition to this fair return. A study of the combined balance sheet of practically all the corporations in the United States will reveal some interesting facts about the methods of capital in taking what does not belong to them. The following statement was compiled by United States Collector of Internal Revenues from the reports submitted by corporations in 1929 in connection with their income tax returns. We can start our study by noting that the stockholders have invested approximately $110 billion in these enterprises. This is the money that was paid in to get them started or to enlarge them. This investment is listed as a liability, and it is balanced among the assets by the capital assets, real estate, buildings, equipment, etc., for which it was spent to the amount of $116 billion. This is the total investment of capital in these corporations, but the statement shows assets and liability of $335 billion, an excess of $225 billion over the amount the stockholders invested. The assets are all owned by the stockholders, and they are responsible for the liabilities. Let us examine the liabilities and see with what burdens the stockholders are loaded beyond the amount of their common and preferred stock. There is one item labeled surplus and undivided profits, and the amount in it is $55 billion. This is money which the stockholders have secured from operations, except for the very small fraction represented by paid-in surpluses, and it is available to them to use it in any way they see fit. By what stretch of the imagination does anyone see clear money in the bank as a liability? It is balanced in the statement by nothing except assets. It is, very evidently, clear of all burdens and liabilities, and is just as much an asset as the cash listed under assets. We will, therefore, transfer this cash to the assets. After taking out the stockholders' investments and the assets that balanced them, we had a remainder of $225 billion on each side. When we transfer the surplus and undivided profits to the assets, we have liability of $170 billion and assets of $280 billion, which unbalances our balance sheet to the extent of $110 billion. The unbalanced statement shows that the assets of the corporations exceed the liabilities by an amount which is slightly more than the total amount of capital paid in by the investors. The assets owned by the stockholders have increased to double the amount of their original investment. Where did the increase come from? Under liabilities is an item bonded debts and mortgages. Bonds are sold by corporations to produce funds for land, new plants, new buildings, or extension of production facilities. The amount of the bonds becomes a debt of the corporation. The income from a sale of bonds is used for exactly the same purpose as the original sale of capital stock, to create capital assets which are added to the property holdings of the stockholders. If a corporation needs money to expand, it should get it by the sale of capital stock and pay dividends to the new investors. That would be the obvious and fair method. If this is done, the present stockholders would have to share their profits of the corporation with a larger number of stockholders. A bond issue sale accomplishes the same purpose as sale of capital stock, and the number of stockholders sharing the total profits is not increased, thereby giving each one a larger amount of profit without additional investment. The phase of the matter that is of more economic importance is involved in the fact that all the expenses of the bonds, payment of interest and payments on principal, come out of the gross income of the corporation, its income from sale of products, and no charges are made against the stockholders or the capital structure while the full benefits go to them. All of the values created through bonds issued become part of the capital structure of the corporations. The same is true of mortgages. The statement shows that $46 billion in bonds and mortgages are being worked into the capital structure. It will only be a matter of time until the entire amount is added to the excess of assets, bringing the total to $156 billion. The miscellaneous liabilities will be paid off out of gross income in the same way, and this will bring the excess of assets over liabilities to $250 billion. These corporations reported for 1929, the year of the balance sheet, gross sales of $118 billion and profits from sales of $27 billion, or 22%. Their total receipts were $161 billion, and their net profits reported as $11.8 billion. Out of the profits, dividends to the amount of $9.6 billion were distributed. The net profits were 8 7/10% of the invested capital and 8 2/10% of the gross receipts. This is a remarkable shrinkage from the 22% profit from gross sales. The $27 billion profits from gross sales was only a part of the profits reported. The corporations reported profits of $28.5 billion from operations other than sales. The two profits totaled $55.5 billion, but through some sort of a shrinking or plowing in process, they diminished to a net profit of less than $12 billion. When production and capital accounts are scrambled in a joint accounting, the mechanisms of the economic process are disguised. The ultimate result, however, cannot be disguised. It is only too obvious that capital has taken to itself a vast share of the income of corporations to which it is not entitled, and has thus become a cancerous growth on the economic circuit that is sapping the life of the country. There is no justification for mixing the accounting of the capital structure of a corporation and the accounting of the production and sales income and its distribution to the producers. The board of directors have no jurisdiction over the gross income of the corporation, have no jurisdiction over any of the income until an amount of it has been turned over to them as their profits on investment. When capital takes jurisdiction over any part of the gross income of a corporation, it does so with the same status as a pirate, sailing the high seas under the black flag, boards a vessel and takes possession of it and its cargo. The gross income belongs to the economic circuit and must be administered in that status. It must be administered by a board of management, entirely independent of the board of directors, under no responsibility to the board of directors except to protect the property representing their investment, and to see that dividends are voted to the directors for the stockholders. The board of management will be responsible for operating the affairs of their producing unit as a part of the economic circuit of the nation, and will conserve the interest of the individual workers and the nation as a whole. Industry must be conducted on an entirely new basis which is founded on the real nature of the community. If this is done, we will not suffer from the flagrant violations of the principles of common honesty which are found throughout industry at the present time. The national welfare, under the present regime of a thieving capitalism, is being dangerously imperiled by the manner in which capital is robbing the economic circuit and degrading the workers who are producing the wealth of the country and maintaining and advancing our civilization. How industry is starving its market by robbing the workers for the benefit of capital is shown very clearly in the case of the electric, light, and power producers. The following average figures for the various steam power companies as distinguished from the hydroelectric companies, presented by the Standard Statistics Company Incorporated, give us a picture of what the typical electric power company does with its gross income. The division into two groups is the work of the author. More than half of the gross income of these electric power companies goes to capital, 50 and 4/10% is diverted for the benefit of the stockholders, and 49 and 6/10 used to pay for the various producing services. The comparison between the 16 and 2/10% of the gross income that goes to the payrolls and the 29 and 0/10 that goes directly to the stockholders is a sample of the means by which capital robs the economic circuit. Note that 16 and 6/10% of the gross income is used to pay off bonds and interest on them. This is money that is transferred directly from gross income into the capital structure and is a fine example of the plowing in process. This is simple, unadulterated robbery of the companies by the stockholders, reaching into the cash box and taking money which does not belong to them. The crime differs in no essential way from that of thugs who rob banks while brandishing machine guns. The fact that the method of robbery used by the stockholders is not classed as a criminal act under our system of laws is an effective commentary on the effectiveness of the control which the money powers exert over our legislatures. If the money taken from gross income to pay interest on and to amortize bonds came out of the stockholders' profits instead of out of the gross income, the wages of all of the employees of the electric power companies could be doubled. If the profits were limited to 6% and the robbery of the gross income by capital were eliminated, the rate for electricity could be cut in half, reduced by 45%. Charging customers twice as much as they would have to pay under an honest system of accounting has prevented the development of the electrical industry and has prevented the full possible utilization of electricity for easing the burdens of daily life in millions of homes. It has, therefore, increased the actual physical burdens of the life for the people of the United States, has increased their financial burdens, in addition to robbing the community of purchasing power. The entire field of industry is permeated with examples of financial ruthlessness and total disregard of the rights of the workers and of the nation as a whole. The American Telephone and Telegraph Company, according to facts brought out in the investigation by the Federal Communication Commission, suffered a revenue drop of 13%, but reduced their payrolls by 26%. The number of stations, subscribers, decreased 10%, and the company reduced the number of its employees 32%. The American Telephone and Telegraph Company maintains reserves, surpluses, etc., to guard against possibility of its payments to stockholders dropping below its standard dividend rate, regardless of any fluctuations in business. When business manifested a major fluctuation downward, the American Telephone and Telegraph Company forced it down still further by reducing its payrolls by double the percentage by which its business declined. When the number of subscribers dropped off to the extent of 10%, it dropped employees off its payrolls to more than 3 times that extent. The American Telephone and Telegraph Company had a greater moral, ethical, and patriotic responsibility to maintain its staff of employees and their wages without reduction than it had to maintain its dividend rate. It completely shirked its responsibility to the nation and took the side of money against the rights of its employees, the people of the United States, and society in general. If the board of directors of the American Telephone and Telegraph Company had the same regard for truth and the laws of nature that prevails in its subsidiary, the Bell Telephone Laboratories, it would not act in such an ignorant and antisocial manner in handling the affairs of this giant organization. It should carry a heavy sense of responsibility to the community which it serves. It should truthfully inform itself of the mechanisms by which the social and economic forces operate by conducting fundamental and unbiased research into the problem instead of accepting, in unquestioning manner, wholly untenable traditional and legalistic business and economic concepts. The further this line of inquiry is pursued, the more shocking and disheartening does the picture become because of the apparent universality of entirely unethical and unmoral, even though entirely legal practices. General Motors has been lauded to the skies for its courage, its progressiveness, its confidence in the future, etc., for some of its recent acts. The corporation voted to stockholders in August 1935 an extra dividend amounting to $32 million, and in the following month it appropriated $50 million for an expansion program. Alfred P. Sloan Jr., president of General Motors Corporation, announced that this appropriation would be used to improve and expand the corporation's productive facilities. And he added, "This highly essential development became possible because of accumulation of earnings." One would assume from this statement that the accumulation of earnings referred to was a balance of net profits not paid out as dividends. Mr. Sloan states that General Motors paid out to its stockholders from 1929 to 1934 more money than the corporation earned. There was no accumulation of earnings during that period. The explanation appears to be contained in another paragraph of Mr. Sloan's statement. To go ahead usually involves some capital outlay. There is available for this the amount set aside yearly for depreciation and obsolescence. In other words, it was not the earnings that supplied this $50 million used as capital money, but it was taken from gross income. There is no justification for such a procedure. Even the stockholders of General Motors have no right to reach into the cash box of the corporation and take a barrel full of money for themselves. This money came from the people who purchased General Motors cars, and who contributed the purchase price of the cars they bought to the gross income of General Motors. Part of this gross income, and therefore part of the price of each car, was used by General Motors as capital. If General Motors had obtained this $50 million by selling capital stock, it would not have been taken out of gross income. If gross income did not have to supply new capital for the corporation, the cost of each car would have been proportionately less, and the selling price could have been reduced by this amount. If, for example, the corporation produced and sold 1 million cars during the period this money was collected, the charge against each car would be $50. General Motors forced each purchaser of one of its cars to supply such an amount of new capital to its stockholders, and in return for it gave the purchasers of the car a value below the purchase price, equal to the amount used as capital. It would make comparatively little difference to the holder of half a dozen shares of General Motors stock if the stockholders were called on to supply this $50 million for capital expenditures. DuPont interests held 24% of General Motors stock at this time. It would make a difference of $12 million to such DuPont interest if the money were supplied by subscriptions from the stockholders instead of taking it out of the gross income of the corporation. The method used made a gift of $12 million to this DuPont interest at the expense of the customers of General Motors and its employees. The $50 million, if left in the gross income of General Motors, would have been available for providing more satisfactory wage payments to the workers engaged in various capacities on the corporation's payroll. This would mean $1 million a week more in wages if the amount were distributed during 1935. If there were 100,000 people on the corporation's payroll, it would average $10 per week additional in each pay envelope. Money was available for such wage increases, yet everyone will recall what a squawk went up from the executives in Detroit when labor tried to organize in the automotive industry for the primary purpose of getting better wages under National Recovery Administration provisions. Labor was successfully squelched as usual, and General Motors celebrated the victory a year later by doubling its dividends and taking for plant improvements and extensions $50 million that should have been left in the production account, where it could have been used for lowering the price of cars, increasing wages, or reducing hours and putting more men to work to relieve unemployment. What General Motors has done differs only in technique, details, and amount from what the Chrysler Corporation has done. And yet, our big businessmen think they are doing the right thing and are wondering deep down in their hearts why the economic system does not achieve a healthier tone. This healthier tone will not be attained until our industrialists experience a change in heart, which will come when they achieve a new viewpoint of the place of the corporation in the economic circuit, of its responsibilities, and of the nature of our national community. The community, the nation, is a living organism. Industry in all of its phases and ramifications is a part of the vital processes by which the community is maintained as a living organism. Corporations are like minor organs created to carry on necessary functions in the community organism. Corporations must be operated in conformity with this basic situation. They must function not for their own benefit, except insofar as they are a part of the community, but primarily for the benefit of the community as a whole. All of their operations, internal and external, all of their income and outgo, must be regulated from this community viewpoint. Economics is, or should be, the science of community physiology. If our corporation executives and our politicians had a thorough knowledge of human physiology and some wisdom, they would recognize the physiological processes in community activity. They would recognize the fact that the whole body must be maintained in a uniform state of nourishment, and unless this is done, none of the organs can be maintained in a healthy functioning state. Industry must function in a physiological manner. Corporations are organs carrying a responsibility for performing certain functions in the vital processes of the community organism. If they do not function in the proper physiological manner, then pathological or diseased conditions develop, and illness and death follow. Our national community is suffering from a dysfunction of its corporation organs. This is curable, and if it is not cured, will result fatally. The actions of our corporations can be likened to a stomach which decided to take advantage of its strategic position. All the nourishment for the body must pass through the stomach. Suppose the stomach decided to take for itself an excess amount of nourishment from the food passing through. It would quickly surround itself with layers of reserve fat. The fat would soon penetrate the tissues of the stomach and would interfere with its functioning. Because the stomach is now unable to properly digest the food, the remainder of the body, already under par because of the past actions of the stomach in taking more than its share of nourishment, fails to perform its functions, and all of the organs break down, bringing about a complete collapse of the body. That is what is happening in our economic system because of the manner in which our corporations have been operating. Industry must get on a safe, sound, and ethical basis of operations. Before it can do this, it must forget its present empiric trial and error methods and adopt a foundation philosophy which will stand as a guide in all operations. Scientific methods must be applied to economics, but we can't wait too long before applying them. The whole system may disintegrate unpleasantly while we delay.